Good evening, everyone. Welcome to this webinar hosted by New Jersey Tamil Peravai, an association of Tamils in New Jersey. I'm Sasikumar Ranganathan, President of New Jersey Tamil Peravai, and I'll be hosting this webinar. At this time of global crisis, when so much of negativity is flowing in our day-to-day life, New Jersey Tamil Peravai is doing various initiatives to spread positivity in the Tamil community. We have initiated a forum called Arivarangam, New Jersey, which spreads positive message within the Tamil community. It also provides an online platform for our children to showcase their talents in various arts such as drawing, singing, recitals, dances, etc. We have planned a series of upcoming events and I encourage you to check out our website njtamilperavai.org for more details. At this time when our daily life is upended, thousands of lives lost due to coronavirus, millions of people lost their job, there are questions about our financial well-being. We saw a booming economy for the past 5+ years. Our investments in various forms such as 401k was soaring in value. Real estate were rising after the 2008 financial crisis. But for the past few weeks, we saw everything being upended. Stock market crashing, values eroded, and oil even going historically low in the negative territory. This is a time of extreme uncertainty and extreme volatility. There are questions about investments in the Tamil community, questions about our 401k. And given that we felt that a webinar explaining how to ride this volatile situation is a need of the hour. Thanks to our sponsors, New York Life Insurance, this webinar was made possible by them. And I thank the team led by Usha, Sweta, and Vidya, who helped me in organizing this webinar. And I thank Mike Downey, who is going to present on this topic. He's an investment consultant, solutions consultant at New York Life. And he will be doing this presentation for the next 45 minutes. And I want to thank my NJ Tamil Peravai team who helped me in organizing the event in several ways, preparing the flyers, marketing the event, and also technically making this possible. On behalf of NJ Tamil Peravai, I welcome everyone joining this webinar today. Please keep your phone on mute for the entire duration of the presentation. Without further ado, let me welcome Mike Downey to give his presentation on market volatility. Thank you.
I'm glad that so many of you are able to join us here tonight. I know that most of you have video up. There are quite a few people dialed in and listening. For those listening in, I'll do my best to explain the graphics of the presentation to you. If it is at all possible for you to log on the video, I know that it will make it a little bit easier to follow along. The presentation that we're doing this night is on market volatility and how you can make it work better for you, how you can adapt to it, and make prudent choices. As an investment solutions consultant with New York Life, I've been doing this for a long time. I've been with the company since July of 1993, so I'll be completing my 27th year and starting my 28th year on July 13th. I've been in the industry since 1986. So I've seen quite a few of these types of events play out, whether it was the crash of '87, which was the first time I lost my job, or it was the savings and loan crisis, the junk bond crisis, the dot-com bust, September 11th, the housing crisis, mortgage crisis, 2008 financial crisis, or today. Been there, done that. And it doesn't mean that what's going on today is not scary. It doesn't mean that it's over. It doesn't mean that it may not be worse than what we've had before. But the strange thing about these shocks to the economy is no matter what it is, they do come along on average every 5 to 7 years, and the big ones about every 10 to 15 years. And it had been coming up on 11 years since the last one. So it seems to be right on time. And in trying to manage your family's finances and your own finances at a time like this, it's very important that you do keep that in perspective. You don't let short-term shocks, you don't let events that might play out for 6 months, a year, even 2 years, suddenly take you off of your 10, 15, and 20-year plans. When it comes to volatility, it really is a matter of perspective. And what I like to point out to our clients and prospects is that volatility goes both ways. When the stock market was going up 20, 25%, when we were having this big boom that started back in the Obama administration and picked up high velocity in the Trump administration, no one was calling up their New York Life professionals. No one was coming up to me when I was doing seminars and saying, Mike, what's going on? The market's going up 20%. I'm worried. The positive volatility everyone likes. But when it goes down 10 or 15%, the negative volatility, suddenly they react 3 times as strongly to the negative volatility. And what you have to realize is that volatility is just fluctuation. Volatility is fluctuation. When the market goes up 30%, you haven't made anything because you haven't sold yet. And when the market goes down 30%, you haven't lost anything because you haven't sold yet. It's just fluctuation. And the unfortunate thing is it's nearly impossible to eliminate volatility. It's the pulse of the market. Without the negative volatility, we won't have the positive volatility. When it's going on, it's human nature for myopia to set in. You're focused in on the bad stuff that's going on right now, and it's hard to remember we've been through this in the past. It's hard to visualize how we're going to get past this into the future. The problem with that is that when you get myopia, when you really zoom in on the short-term volatility that's going on, you can miss out on the opportunities you'll have over the long term, and you can take rash moves, rash steps that can make what was fluctuation become loss. And when fluctuation becomes loss, it's very hard to recover from that. The professionals in New York Life that I've been able to work with now, going on almost 28 years, have just been great at helping folks to balance their riskier investments with lower risk investments, to make sure that you have guarantees, you have liquidity, you have growth. And whether you're working with New York Life or whoever you're working with, or even if you're doing it yourself, that's what it comes down to. If you have perspective, you can make it through these times. This chart, I think, is a very instructive one because it is showing the period from December 1987 to December of 2019. And over that 32-year period, overall, the market was pretty darn good. I mean, in August of 1987, the Dow Jones Industrial Average hit 2,700, an all-time high. By the time we get through the crash of 1987 in October, the Dow Jones was down to about 2,000 and was limping along trying to come back as we got to the end of the year. When you go from 1987 all the way to 2019, you can see that every few quarters, the market would have a big downturn. A lot of people don't even remember these downturns. In fact, if you look at the right side of the screen, we're showing a downturn that happened at the end of 2018. I would dare say that most Americans don't remember that the market was down almost 13% in the fourth quarter of 2018. It's forgotten now. But yeah, that happened. It's just that it didn't last too long, and it was followed by a huge recovery the following quarter. So they forgot about it. When you draw out the line, when you look at the market over the long haul, it becomes a lot easier to see how those short-term fluctuations really don't matter very much. This is the same time period from December of 1987 through now. And my goodness, look at the things that have happened over this time. About 8 months after we started tracking the market, we had the start of the first Gulf War against Saddam Hussein with the coalition of nations from around the world under President George H. Bush. We got up, we had, of course, the big boom going into the year 2000, followed by the bust, and then punctuated by the September 11th attacks. The market dropped back down. We had the big recovery and the Great Recession from 2007 to 2010. Then we had the U.S. default on its debt back in 2011 when the Republicans, in battling with the Obama administration, refused to increase the debt limit. We had when Britain left the European Union in June of 2016. And of course, we've had the trade war and the other things going on with China. But all through this time, a $10,000 investment 32 years ago would be worth $265,000 today. But only if you got in and you stayed in. Only if you didn't let that short-term volatility distract you. Here's another way of looking at that volatility. In 24 of the last 33 years, the market realized a positive year-end return, even though it had some big intra-year declines. You go back to 1987, at one point the market was down 30.17% on the left side of the chart, but it finished the year up 2.03. A lot of people who went through the crash of 87 don't realize that. The year ended modestly positive. If you go back to 2001, the market at one point was down 28.99, but finished the year down 23. Now, negative 23 is nothing to write home about, but it's still a lot better than down almost 29. If you go over to 2008, at one point the market was down 38.96. It finished the year down 38.49. And the very next year, when no one wanted to be in the stock market, it had a negative 18.6% return in one quarter, but finished the year up 23.45. And I would dare say most of you on this call today and this webinar probably don't remember or realize that in 2009, the market was positive. That was the time when President Obama was first elected. That was the time of the bailouts and the TARP and the banks and everything else. People forget that the market was up strong double digits that year. It's all about staying the course. And this next chart is showing different financial crises that have happened and how when you least expected it, the market had its big recovery from the downturn. The Great Depression started in 1929 with an 8.5% loss, followed by a almost 25% loss in 1930, and a 43% loss in 1931, and another 8% loss in 1932. All told, the market went down 84% in 3 years. In 1933, when very few people would have thought it was a good time to be in the market was up almost 54%. In World War II, with the defeat of the French and the British being driven out of Europe, we had a negative 0.5% return in 1939, followed by a 9.8% loss in 1940 and an 11.4% loss in 1941. That was followed by a 20.34% recovery in 1942. And many Americans, when they look back on that period, will say, well, yeah, we won World War II. We didn't know we were going to win World War II in 1942. In 1942, we were just a year out from seeing the entire Pacific Fleet put to the bottom of Pearl Harbor. In 1942, the United States had lost Guam and the Philippines, and the British had lost Indonesia, and Japan was running rampant around the Pacific. The Germans were invading Africa. The Germans were attacking Greece. And even in the face of that, the market was up 20%. We go back to the oil crisis in the 1970s, and over a 2-year period, the market lost almost 30% of its value. But in 1975, when no one was thinking that the market would come back, it was up 37%. And when we go back to 2000 to 2002, when the dot-com bust happened, we lost 9% and then 11% and then 22%. But in 2003, the market was up 28%. Here's the problem. If you weren't there for when it came back up, then the numbers don't matter. If you got out after it went down and didn't get back in, which most people don't, because it's human nature to not want to risk it again, you weren't there for the recovery. See, fluctuation is not loss unless you choose to lose. If you move out when the market's down, you lock in the loss. But we understand it can be scary. The next chart is showing just how volatile the market can be. We're showing 1, 5, 10, and 20-year returns of the S&P 500 index for the past 40 years. The best 1-year return of the S&P 500 since 1979 was positive 37.5%. And the worst 1-year performance of the S&P 500 over the last 40 years was negative 37%, which is as close to bipolar as you can get. They're exact opposites. But if you go out on a 5-year basis, if you look at the best 5-year performance of the S&P over the last 40 years, it was up 28.5. And its worst 5-year, it was down 2.3% per year. On a 10-year basis, its best 10-year, it averaged 19.2% per year for 10 years. And its worst 10-year, it lost 1.38% per year for 10 years. But somewhere between the 10-year and 20-year mark, the magic happens. On a 20-year basis, the best 20-year average return was 17.88. But the worst 20-year return was still positive. It was 5.62. So even in the worst of times, the worst 20-year period of the stock market, you average 5.6% a year. At a 5% return, your money doubles every 14 years. So your money would have doubled twice with the worst 20-year performance over the last 40 years. When times like this happen, when the negative volatility kind of frightens you or maybe even hurts you if you need your money soon, it's time to assess and adjust your portfolio. If you can manage volatility, if you can make sure you have the right mix of risk and safety, the right mix of tax protected and tax exposed, the right mix of currently available money and retirement money. You'll make it through this. Every down market creates a buying opportunity. If you are 10 years or more away from your child's college education expenses or your retirement or whatever unique goal you set for yourself, you don't really have to worry about what's going on now. If you are less than 10 years, especially if you're less than 5 years, you probably already should have started moving to more conservative investments and getting ready for your transition. If you hadn't done that, then what we would recommend is that you start making the moves now. And I get people who say that, you know, I'm just not going to move now because the market's gone down so much. I don't want to lock in these losses. There's nothing to say that the market can't go down more, folks. As it is right now, you're still up from where you were in 2015 or 2013 or 2011 or 2009. But if there is another move down, it could get worse before it gets better. And if you're going to need your money within the next 5 years, it's incredibly risky to try to play this out because you want to make more. Just try to lose less if you can. If you have that 10 years or longer to go, you have to look at these market swings as being buying opportunities. If you're putting money into your 401k every 2 weeks, into your IRA every month, keep it up. Don't stop. Remember, if you liked investing in the stock market at 27,000, you should love investing into it at 19,000 because it's a lot less expensive. Investments are about the only things that people don't like to buy when they're on sale. And if it's 10 years or longer to go, don't get distracted. If you can navigate the ups and downs of the market, you're going to reach your goal. Now, we have a chart that's up here for the folks who are on the listen-only mode that I'm going to walk you through. I'll walk you through the math on it. We came up with 3 investors, a tale of 3 investors, 3 people who had $10,000 to invest back in 2007. And each of them invested, but they all behaved differently afterwards. Investor A put the $10,000 in, and when the financial crisis hit and everything went to heck in a handbasket and the market went down 52%, this person stayed invested. Her $10,000 investment today would be worth $28,417 because she didn't panic. Investor B invested $10,000 on the same day, but when the crisis hit, he decided to move his money out of the stock market into cash, whether it's a money market or a bank, and wait a year to see how things shook out. You know, this guy Obama got elected. Will he be able to save the economy? What's going to go on? And basically waited until early 2010 to get back in. In early 2010, put his money back in the market. And as we move forward to today, he'd have $18,498. So he still grew his money pretty well. Of course, if he had done nothing, he'd have $10,000 more. Investor C got spooked out of the market, moved to cash, and never got back in. And I've seen a lot of people like this. They moved out, and then the market got worse. And they said, thank God I got out. I missed the worst of it. When the market began recovering, they had a choice to make. Should they get back in? Well, most people who get out and avoid the worst of it have a hard time getting back in because they keep on second guessing themselves. What if it's not over? What if it gets worse? And they wait and they wait and they wait. And before you know it, the market's up above where it was when they got out. And now they're saying, if I go in now, I'll be paying even more than I made when I got in. I don't want to do that. So they get stuck on the sidelines. That investor today would have seen his $5,155 grow to only $5,534. That's what we call the wages of sin. Another thing for perspective, for those of you who are listening, I'll describe here. We tracked the stock market over the last 15 years. Over the last 15 years, the stock market was open roughly 4,500 days, 4,400 days to be exact. 4,400 days where the stock market went up, down, or sideways, okay? If you had invested at the beginning of that period and just let your money stay in there for that 4,400 days, a $10,000 investment would have grown to $36,000. You would have averaged 9% per year. But if you had missed 10 of those 4,400 days, If you were invested for 4,390 days, but the 10 days you missed were the 10 best, your performance dropped from a 9% return to a 4% return. Your $10,000 only grew to $18,000. And if you missed the 20 best days out of 4,400 days, your 10,000 only grew to 11,900, an average return of 1.17. And get this, if you missed the 30 best days out of 4,400 days, you lost 1.35% a year. Your $10,000 shrunk to $8,150. Now, some folks would say, well, you're talking about the best days. What if I missed the worst days? What if I timed it right and I managed to not be invested when it had its worst days? Well, you would have made more than 9% a year. That's true. Just you have to tell me when those best days are going to be. Because I've been doing this since 1986 and I don't know. Our chief investment officers at New York Life down the years have always tended to be more conservative folks. Gary Wendlandt, who drove us through the financial crisis of 2008, our total losses in 2008 were less than 5%. Gary Wendlandt had moved a lot of our money to safer investments in late 2007. And he was asked after the financial crisis how he knew the market was going to go down. And he said, I didn't know. No one knows. It's impossible to know. But what I did know was that you don't win forever. You don't win forever. And so rather than being greedy, I decided I would move some of my money to more conservative investments. And that's how he saved us. So if the folks who are running the general account of a 175-year-old company don't know when the market's going to go down, if the professional money managers on Wall Street running mutual funds for New York Life's mainstay funds or American funds or Fidelity don't know when it's going to go down, what are the odds that the person on CNBC or Fox Business is going to know when it's going to go down? Look, they're very entertaining. If you like Stuart Varney, if you like Jim Cramer for entertainment, that's great. They will tell you how they are great investors, that they're some of the most successful investors in history. But ask yourself this question. If they're such successful investors, why do they have to show up for work every day and go on TV and entertain you for 2 hours? Why do they have to go to Barnes and Nobles and charge you $10 for an autographed copy of their book? If they were great investors, they would own a small country and none of us would know what they look like. So that's just perspective from New York Life. You want to just keep a long-term perspective and not try to go for gimmicks that promise to get rich quick or help you avoid a downturn. When you're investing, you should always keep volatility in mind because your reaction to volatility is going to determine your success. If you're somebody who invests into a portfolio that is too risky for your risk tolerance, there's a high likelihood that if that portfolio suddenly dramatically goes down, you're going to panic and get out. It doesn't matter if that portfolio is going to make more money over the long haul. You won't because you didn't stay in. Also, when you're putting money in the market, one of the best strategies for growing your money over time is to invest regularly through what we call dollar cost averaging. That's where you put money in every month or every 3 months, like clockwork. It's what most of us already are doing in our 401ks or retirement plans at work. And that's why 401ks usually do work. Your money comes out of your paycheck every 2 weeks and goes in without you really thinking about it. When the price of the stock market is low, you buy more because it's on sale. When the price is high, you buy less because it's fully priced. It's the way we go shopping for everything, whether we're shopping for tuna or we're shopping for the doll or we're shopping for pond, whatever we're shopping for, we're going to tend to go and buy more when it's on sale. But when it comes to investments, most people want to buy more when it's fully priced and less when it's on sale. Dollar cost averaging forces you to buy when it's cheaper. And it's just common sense investing. If you invest regularly, you're putting time on your side. Money coming out of your paycheck or out of your checking account every month and going into the market is forced savings. It stops you from spending that money. We find that a lot of folks in this country spend money they don't have to buy things they don't need to impress people they don't like. It's a joke I've made for years. And why not just invest and save the money? I don't care what product you're putting it into. Mutual funds, stocks and bonds in a brokerage account, some type of annuity or insurance product that invests in the market. There's lots of ways that you can grow. If you keep your investment goals in mind and you take the right amount of risk given your time horizon, you're going to do well. A mistake many people make after a financial crisis like this is to be too conservative. regardless of age. If you're in your 30s or 40s, here's what I can tell you. The stock market's going to blow up at least 7 or 8 times before you get to 65. But here's the good news. It's not going to matter. The stock market climbs a wall of worry. If you are 6 years or 7 years away from your goal, you probably shouldn't be that aggressive to begin with. And even if the market was still at all-time highs, even if Corona hadn't happened, if you were less than 5 years away from your goal, your New York Life professional would have been telling you, it's time for us to take some of this money off the table. And that was hard to do for a lot of people because when the market's hot, everyone's afraid they're going to miss out. Well, I just point out to you, it doesn't always win. If you want to take advantage of market opportunities, it's important that you stay aware of what's going on with your account. If you have a financial professional, you should meet with that person at least once a year, and he or she should reach out to you periodically to see if anything's changed in your life, to make sure you understand what's going on. When you have questions, you should reach out to your professional and be able to get good answers on what's going on with your account. You got to make sure that you maintain your focus on your long-term goals. And you got to take the emotion out. If you can take the emotion out of investing and put courage in, you're going to get to where you need to be. We have some resources at New York Life that people can use for perspective. Even if you don't invest with us, even if you're a do-it-yourselfer working with Fidelity or one of the other do-it-yourself, no-help companies, you can still go to our websites and read about some of our things. We have a website, www.lowvolatilitysolutions.com, which can give you some ideas on how to reduce the risk in your portfolio. Speaking about risk, we didn't go into individual products here tonight by design. As I've told Usha and everyone who will listen at New York Life, I've been doing this a long time, and I don't think that people want to come to a seminar to be told about your product. Now, let me tell you about my product. No, I think people want to come to get information that informs them and enlightens them so they can make better decisions about what to do with their life. If we can help them with those decisions, we will show them the products we have that we believe are the right fit for what they're trying to do. And Usha and her team will specialize. They take a fiduciary responsibility that they have to act in your best interest. They have to put you through a fact-finding process where they find out what you've been doing with your money, what you're trying to achieve, what type of risks you have. They ask where your other money is, not because they're going to take it. They ask so that they can make sure whatever we do here is not going to interact with what you're doing elsewhere in a bad way. It's like when your doctor wants to make sure that she knows all the medications you're taking, because another doctor might have prescribed something for you that can interact with what she's prescribing for you. However, I do want to advise you that if you want to get more information on New York Life's investments, you would need a prospectus. And before we'd ever be able to do any investing for you in our mutual funds or our variable annuities or variable life policies, we'd have to give you a prospectus first. If you want to get prospectus information on our mainstay mutual funds, you can visit nylinvestments.com or speak with one of the professional registered representatives from Usha's team, and they can provide you prospectuses on our mainstay mutual funds. If you want information on our variable annuity or variable life options, which are mutual funds that are inside of guaranteed contracts where you pay extra to protect your money, you can download those prospectuses from newyorklife.com by going to newyorklife.com and clicking on invest and then downloading the prospectus, or again, by speaking with Usha or a member of her team. We always encourage you that you read the prospectus carefully before you ever make any investment decisions. I know that Usha and her team would do their best to explain that to you. And if you get to the point where after doing the initial fact finding and looking at your situation, it's time to discuss potential solutions, they often bring me in to be the expert to talk about some of the solutions, to answer the more disciplined questions, and even to help you when you're crafting your investment allocation. So that's the end of the formal presentation that I had for today. I can definitely turn the control of the screen back over to you, but I also want to say if anyone has any questions, I'd be glad to answer them at this time.
So I have a question. This is Nimaram, by the way.
Hello.
So let's say, all right. So let's say I already have invested some money, and let's say I have some extra cash at this point. And when is the right time? Obviously right now it's it's very uncertain, So
Yeah.
what are the parameters, or what exactly I should be looking for, to know that, okay, this is the right time I should put my money for maybe, let's say, 5 years or 10 years or.
Well, I'm going to say this. If you're going to invest into the stock market or into the bond market, if you're going to invest into any type of a market-based investment, your time horizon should be at least 10 years.
Okay.
If you're going less than 10 years, you're gambling. We call it speculating. Speculating is a nice word for gambling. You're probably better off going down to Monmouth Racetrack or Atlantic City in that case. Because if you invest that money for like a 5-year time period, the market is very inefficient. You have a higher risk that it might not work out for you. And if you do that, then you might find yourself 5 years from now not able to make the decisions or the investments or the expenses that you need to make because the market didn't cooperate. But if you can go 10 years or further out, I don't think you have to worry about what the market does over the next 2 years. And I will tell you, no one knows if this is over yet. Most of the public health experts believe there will be a second wave of corona in the fall, and we'll probably have to kind of shut down the economy or slow it down a lot more then. Hopefully we can do it better than now. We'll be better prepared. But that will be a drag on the economy. And as a result of what's going on here, even though we're going to get through this, even though there are companies like Zoom and 5G network providers that are making incredible money and probably will do even better. Netflix will do even better. Disney Plus will do even better because people aren't going to movie theaters. There are going to be other companies that are going to fail. You could see more than half of the cruise companies in this country, in the world, I should say, disappear. You could see the number of hotels available drop by almost 25%. You could see a huge drop in the number of restaurants that are out there and failed businesses, both on the big chains and on the small independents. So there's still a long way to go on this. Okay.
Yep. Right. Thank you.
Sure.
Hey, Mike.
Yeah, if you have any questions, please unmute yourself and then you can ask the questions.
Thanks, Ashish.
Thank you.
Hi, this is Arun. Thank you for sharing your insight about investment. I just have one question, which is more on the economic surplus. So as you see some of the slides which you have shared earlier, which kind of show that there is a drop, and I'm relating it more to the GDP drop of annual output. So my understanding is the drop of GDP, it's going to be around like 10 to 15% down on a worst case scenario basis. What are your thoughts about the global economy down with respect to the overall market? And when do you see that the market is going to perform normal as such somewhere in, I'm talking about somewhere around like 2015, 2016, not like a bullish market, but come up from the bearish market?
Well, I'm going to tell you again, my crystal ball doesn't work. And when people tell you they know when it's going to turn around, they're being too confident. But what we're dealing with right now is a demand drop. And it's an artificial demand drop caused by the fact that people are sheltering in place and can't get out. As testing to monitor infection rates gets better, that's going to help to reopen the economy. A lot of people are stir crazy. And when they are safe to go out, their pent-up demand is going to drive a lot of buying. Right now, people aren't splurging on fun things for the most part. It's food, it's bathroom tissue. I mean, that's the main stuff they're going after. So when this opens up, you're going to see pent-up demand cause a lot of buying. You're also going to see, though, that as we try to figure out how to navigate the unemployment and the effect on debt, that's going to be a big thing. If you're reading the news today, Ruth's Chris, one of the most criticized companies for taking a huge bailout loan from the government, has decided to return it. Shake Shack had already given theirs back. A lot of this money is going back in the system, will filter down to the smaller businesses out there. The hotel chains are doing that too. And that could have a big impact. We might also see an experiment on the second or third wave of support spending, similar to what they're doing in the Netherlands. In the Netherlands, the government has guaranteed everyone's salary so that businesses don't go under and people can keep living at the same level. And then when it all comes back on, the people will just be able to go back to work and they'll start the economy quicker. So we'll see. We'll see. Thank you.
I have a question. My name is Jason. Thank you so much for your presentation, as well as guiding through certain investing principles that you might have gathered over the years. One question that I have is, back in 2008, the Great Recession, the opportunity just slipped right in front of my ears across the years, meaning I saw the market collapse. I was afraid to enter. I could never time the entry. So that way I just missed the entire thing. Now I'm treating this as an opportunity. As a newcomer to stock investing or other investments, I know you suggested that there is no way we can time the market, but what are the entry points, or what are the times of entry? Do I enter, say, 10% of what I have at hand at different frequencies, or any suggestion in this regard might be very helpful. Thank you, upfront.
Sure. Well, that's more of an individual question, which normally I'd say sit down with a financial advisor one-on-one to go over that. Because here's the thing. Yeah, no one knows if the market's going to be cheaper 6 months from now than it is today, or if we're going to be past all this in 6 months. As far as an entry point, if you're not going to need your money for 10 or 15 or 20 years, whether you buy on the all-time high price of this year or the all-time low price of this year is going to make virtually no difference. I know that from history. It's not timing, it's just time. The biggest thing you'll have to deal with is that if you do decide to get in this year, now, let's say, and the market's 20% cheaper 3 years from now, you might be 3 months from now, you might be kicking yourself. And you can't do that to yourself. When you second guess yourself, that's how you hurt yourself. It's just like when I go to people now, as I mentioned earlier, who are saying I should have gotten out when the market was at 27,000. And they're regretting that. And I'm saying, well, are you still up? When did you invest? I invested in 2015. Well, you're still way up from where you were in 2015. You still made a lot of money. What's the problem? Well, I could have made more money. Yeah, okay. You can't live in that world of regret. If you've made money, that's good. What's wrong with it? You could have made more. You didn't. Don't worry about that. But if you're going to have 10 years or 15 years to go, don't try to time it. If you're worried that you might commit it all at once, set up what we call a systematic investment plan to ease the money in. I know New York Life has vehicles where people will put a lump sum in and we move it in over 6 months. And they pick up a little extra interest on the way. I think I have time for one more question, if there is one more.
Hi, is that good time to buy a home or can wait for a couple of months? The Fed rate is 0 right now. So does it impact to go for the home or should wait for the COVID-19 system?
Well, I'm going to say this. There's a lot of talk going on about that. Realtors and people selling homes are having a really hard time making it happen now because of all the interaction that has to be done with inspections and notaries and everything else. But the mortgage companies are working fast and hard, and the realtors fast and hard to figure out how to do this, maintaining social distancing. Also, mortgage rates have gone down dramatically because of the collapse of interest rates. If your job is very secure, that you don't have worries about being able to make the payment, and you work with a good mortgage broker and get a good rate, this could be a good time to buy a home. You might not see rates this low again for 30 years. I want to thank you all for having me here tonight. I hope that you found this information useful and helpful. And if you're ever looking to see how to apply some of this individually to your particular needs, the team at our New York Life offices down in Edison and in Saddlebrook, New Jersey are definitely there to help you. And I want to thank you all for letting me join you tonight. I want to thank Usha. I want to wish you all a great night, good health, and safety. Thank you.
Thanks, Mike, for this presentation. I hope this webinar is useful for everyone. I'd like to thank everyone who joined this presentation. We had a really good turnout. Thank you all. I also want to thank my New Jersey Tamil Peravai team for helping me to organize this webinar. Undidivom, Corona Vendidivom. Please stay safe and stay at home. Good night.